nuts following COVID, and folks are now wondering if prices are going to stay that high or if there might be some relief for car buyers going forward. So a number of questions for you, but let's just start with a general one, which is what's your current assessment of the auto market right now?
Boy, that's a big question, but I'd say right now we're cautiously optimistic. It's been a real challenge, and we just don't see as much downside potential for the new vehicle market as well as the used market, because we've already fallen quite a bit from sort of our 17 million plateau we were at pre-COVID. And a lot of the folks that would normally, as we head into this higher interest rate environment, potential of a recession next year, a lot of a much more affluent buyer marketplace. It was folks with larger incomes, the folks with questionable incomes, subprime type buyers were essentially pushed out of the new vehicle market. It just got too expensive for them, and there was just too much uncertainty in the economy, as well as possibly being hit by COVID. Are making it it makes economic sense to get my money out of my savings account where I'm only getting 2-3% maybe, and buying a car as opposed to signing up for a 7-9% car loan. And so people are making that arbitrage that just using their cash to buy these vehicles is the way to go in this high interest rate environment. Clearly that cash is going to end at some point. People don't have unlimited savings accounts. But in terms of what's fueling the market right now, it's wealthier buyers are sort of eating up or mitigating some of the higher costs that we're seeing as a result of higher interest rates. We just kind of see that sort of the status quo going forward, with a major headwind being these higher interest.
Before we ask that, you talked about inventory levels beginning to get back to normal. Maybe we can talk for a moment about how out of whack they got during COVID, because, I mean, when we shut down the economy in general, but as I understand it as a layman, so please correct any misunderstandings I have, is that the big thing that hit the car market was the shortage of chips, of microchips, and that you had a bunch of cars that were built but couldn't actually be delivered because they were waiting on the chips to go in them. And I guess I got a couple questions around that. But, is there a bit of a potential for a bullwhip effect here?
In 2020 and similar amount for the last couple of years, a little bit, we're only going to do about 13.7 million this year. All of that means that there's less used cars that are going to be available from that, even just those 3 years. We have millions of fewer vehicles, and within that we have millions of fewer fleet vehicles which supply the used market. We have millions of fewer lease vehicles. Leasing volumes are down substantially, and leasing share of the market is down substantially. All of this is the funnels of used supply that provide those CPO type vehicles and gently used vehicles that consumers really like. They're going to be under very, very limited quantities here when we look forward out to 2023 and beyond. And so that is something we look at.
Perception here, but, or I don't know, let's see. So in 2020 and 2021, did the manufacturers make fewer new cars, or did they make the same amount of new cars but just couldn't deliver them on time because they didn't have chips? Right, so
no, they made fewer. They made fewer.
They did
so
make
there were
fewer. Okay.
There were some vehicles that were partially built. So everything built, but a few chips that had to be popped in here or there. There were tens of thousands of these vehicles, and they got some headlines. But the big story was literally that the production itself had to shut down. And initially, because of COVID itself, we shut down the factories for a couple of weeks in March and April and May of 2020. Was in the undercarriage of the vehicle. That really impacted many European manufacturers. Palladium, which is used for many electronic components, as well as catalytic converters and chip manufacturing, silicon chip manufacturing, that's mined out of Ukraine. That was disrupted during the Ukraine war. And of course, in the U.S. itself, I'm based in Detroit. We hear quite a bit about labor shortages for the supply base even here. They're having a difficult time finding workers. And of course, the China COVID closures, they've been shutting down factories, opening them up, shutting them down. Really, for the last 2 years, it's been as well as the supply itself on dealer lots across the country is definitely starting to improve. But I will say that's in the aggregate. Some manufacturers are still incredibly lean. We look at many of the Asian brands like Hyundai and Kia, Honda, as well as Toyota, still have very, very lean inventories out there. The product availability on dealer lots is, you probably have a hard time even finding product at many places. Versus many American brands, particularly pickup trucks, are showing quite a bit of day supply, probably too much. And this is what we're going to be looking for in 2023 is they've been leaning
of these massive parking lots and unused airport runways and racetracks where there were just thousands, as far as the eye could see, cars that were just awaiting ships for some of the other components that you were talking about. And while that maybe grabs the attention, you're saying it tells a false story. In other words, it's not excess inventory building up. We were producing less than we normally do. And it sounds like even some producers right now are still a bit constrained, particularly the Asian ones that you're talking about here. So this story is still one of inventory shortage.
We probably had much tighter availability because they just weren't focused on producing as many of those. They stuck to the higher margin products. But we're probably in a market now today with these higher interest rates that the demand for those lower priced products is even greater than ever.
Right, and higher gas prices too.
And of course higher gas prices, but the industry's really not that interested in fulfilling that demand. I think that they're just, those buyers are going to get pushed into the used market if you're not willing and able to shell out the $50,000 for the new vehicle.
And that's just because they're making so much better margin on these more expensive vehicles?
These higher prices have really changed the game. I was just crunching some numbers the other day, and year-to-date sales were down about 9%. Year-to-date, just back of the envelope, transaction price times sales revenue, that's always been the dream of the industry, that they can get away from having to do substantial discounting. And I think that as an industry, they certainly would like to keep that as the way pricing goes from now forward. But as I said, that's going to be the challenge. Can they maintain that pricing discipline as inventories are rebuilding? There's a lot of internal pressure to keep manufacturing going and keep sales as high as they can be and grab as much market share as possible. But all of that will require discounting of vehicles, doing more incentives, more interest rate subsidies. And the industry would probably prefer not to do that, but that's the game of chicken we're going to be seeing here going forward.
Okay, then let me look at it 2000.
Those monthly payments. But as I said, it's the downside risk is there, but normally, like when we entered into the 2008-2009 recession, we were at a 16-17 million market and we fell off of the cliff. We fell down to the 10.4 million in 2 years. Huge decline. Right. But that was because we still had all these subprime, lower income folks out there. It was 30% of sales were people with subprime credit score. Today, it's half of them in the market. So if we do have a recession, we've already lost a huge portion of those buyers that we would lose from a recession. And that was what I was trying to say initially. But clearly, there are downside risks. Where we do see the upside potential is the fact that many of these Asian brands' activity has been quite muted the last couple of years. One thing that we've seen so far is that the interest in travel remains very, very high. The rental car companies were not able to get product immediately post-COVID, and they started buying in the used car market. But now the manufacturers can get back to supply rental vehicles. And so I think we're going to see much more fleet activity in 2023 as well. And the other lever that the industry can pull, as I mentioned before, is leasing. They pulled back substantially on leasing. Prior to COVID in 2019, leasing was about 30% of all retail activity. And so it was a way to provide a low-cost option for folks who want a new vehicle. They want all the bells and whistles, the new technology. As part of it, the deals just aren't that great. The industry, the manufacturers aren't pushing leasing that much. So if you're given a sale or a lease, I'd much rather sell to you than lease to you. And so they really haven't been pushing it. But and of course, we saw this huge run-up in used vehicle values last year. Many of them pick it again if they wanted to get sales going. And as I said, that's kind of what we're expecting for the balance for this year. Is it's essentially a flat market with the potential that if the industry gets really aggressive on discounting, sort of back to pre-COVID type levels, they could really push hundreds of thousands of additional sales onto the market that we might not have had otherwise. And so that's why we kind of see the market as essentially the same next year, but just a little bit better. But clearly the headwinds remain.
Okay, so you sort of expect the current buying profile in the new car market to remain the same in general, where it's these higher ticket buyers that are coming in. Hopefully,
opposed to coming in on a Saturday and going home that afternoon with a vehicle.
Right.
That's how the rest of the world buys vehicles. That's how they do it in Europe. That's how they do it in Asia. The idea of going home with a vehicle today because I went to fix some tires is a very American type process for car buying. It's changed quite a bit in the post-COVID market. There's been much more ordering because of the lean inventory. For consumers that want exactly what they want, they've been forced to come in and order with their dealer and wait patiently weeks or months in most cases for that product to come in. All of that's allowed for this price strengthening that I think the industry is going to want to maintain for as long as possible, because really during this whole couple of years post-COVID, can they maintain the silver lining within this dark cloud? That's going to be the question.
Okay, and that's really interesting. I'm curious, do you think that this shift in new car buying to basically pre-ordering it will be a permanent one for the industry?
I think for many manufacturers, they're going to try and steer more and more. And I wouldn't be surprised if we don't start seeing incentives geared that way, and that it rewards patience.
Right.
You need to come in today and go home with a vehicle, you pay full price.
Pay more.
If you can come in and order and wait, we'll give you a discount. Totally changing the whole incentives game right on its head.
And those all make sense. I totally get that. All right, so on the used car market, it sounds like it is still going to be constrained of inventory for a while, just because there hasn't been as much moving from the new to used in the past couple of years as you described. Are there any other factors about the used car market, either positive or negative, we haven't talked about yet?
Well, I think it does seem likely that prices are going to continue to come down here for maybe throughout 2023. They're going to start drifting down, at least in the aggregate, because there was such an increase over the last 2 years. It was really not sustainable. It was just not a normal rise in the marketplace.
Right.
I mean, just some really odd stuff out there. But the dust is all starting to settle. And the one thing we can see is that pricing patterns appear to be moving back towards normal. We're starting to see more normal depreciation patterns. We are starting to see prices come back down. And so I do think that we're starting to see some of the froth come out of these prices. But one of the things I think it's important to point out is we just don't see any collapse in the market. We've seen a huge move in interest rates over the last 6 months. You would think that if it was going to decimate automotive sales, it would have done so by now, or we'd be able to see all kinds of kinks in our charts showing we have a whole new slew of customer buyers in the used market today that we didn't have prior to COVID. Again, more affluent, looking for these expensive products because they just can't quite afford the new side. That's going to provide a lot of support for these vehicle prices. So we see the used market as being down a little bit this year, as opposed to the new market being up a little bit. But again, we don't see any substantial collapse happening.
Okay. There's a chart that I'll try to put up here of trying to estimate how much of the extraordinary stimulus that was delivered to households during the pandemic response is still in the system. Sort of get a car, make a down payment on the car. How material a factor, if indeed that is true, that the pig is finally through the python by around June or July, what kind of impact do you expect that to have? I guess right now maybe not so much. It sounds like you're not really waiting for it, so.
Well, as I said, cash purchases as a share of the market are up. Clearly, the number you're talking about would go right to them. Cash on hand to make a purchase. That's going to get drawn down. I think certainly in the second half of the year, we're probably going to see a consumer in a little bit tougher situation. Like I said, we're concerned about that, but there's still a need for personal transportation out there. Even though we've seen transportation want a vehicle, and they made those car payments, we did not see the same type of default rates in the auto loan market. And I think that suggests that Wall Street is still going to want to lend to the automotive market for those reasons, that if nothing else, it's a secured asset where I can just go repo that vehicle, and I've got my loan back essentially. And I think in this environment, when things are difficult out there, Wall Street's going to look for the land. It was successful before, as I said. And when we look today, the composition of the new vehicle market is really quite strong. As I said, the share of the market that's subprime is down substantially. It's now starting to come back to earth, just like all the other inflation measures appear to be coming back down. But that's something that the industry has had to force upon consumers. It's not like they can just eat those additional costs. And of course, the move towards electric vehicles in general are a more expensive product, and that's sort of raising the average. So, Tesla going from 1% market share to 4% market share during this post-COVID market, and their high-priced Model 3 and Model Ys is certainly also contributing to a rise in national average numbers for vehicle prices. And that shift towards electric vehicles isn't going away anytime soon. So I think it's the upward trend.
Kind of like during the housing boom of 06, 07, they were making ninja loans and really just giving loans to anybody who could fog a mirror. And there sort of was a narrative that was going on in the auto market because prices were hot and everybody was desperate to get into a car, and people were getting checks in the mail and using those as their first down payment. So I guess just comment on any of that. There are some people that are concerned that, hey, auto loans could be this generation's subprime. I think you just gave some rationale why you maybe don't think that's the case, but is there any reason to be concerned about the quality of the economy
as maybe some of the packaged bank loans come under threat if it becomes a much bigger problem? But at this point, as I said, because even though subprime is starting to default more, it's a much smaller portion of the market. It's just not the concern that might have been otherwise. And as I said, we've already seen such a major correction in the vehicle market over the last 2 years. From here, it just doesn't seem like there's much more downside risk, at least when it comes to sales. Now, when it comes to the loans themselves, I have heard a little bit about that, but I haven't heard, and I think that's just something we're going to see revealed this time around too, is that we got a little too loosey-goosey on the credit out there with some of the borrowers.
And I imagine the composition of the loan quality is different between the new and the used market. And you basically said the new market is a lot more affluent buyers. Could this be a bigger problem in the used market?
I think that's probably where you would see it. And I think one of the major concerns out there is not just that consumers did they borrow money on vehicles that maybe they shouldn't have bought, but dealers themselves, and did they buy inventory at a high price? Bigger effect on the economy or a much greater effect on auto loans. I haven't seen that just yet.
Okay. And last question on this topic. I've heard through interviews on the internet with guys in the used market. Here's the anecdote. That in market down cycles, the repo business really, does better, right? And these guys.
I can't say I've heard anything about that, but I will say, prices are still pretty elevated, that it may be many of those repossessed vehicles are still in the market. So it's not necessarily a losing proposition to get that vehicle back to the lender. Again, these repossessions normally in normal times, you'd be like, oh my gosh, repossessions are going through the roof. It may also be a windfall for some of these vehicles, depending on what the product is and how much it's priced from the repossessor. So yeah, I think that technology is going to be the lender's friend here.
Okay, great. Well, Charlie, look, thank you so much. This has been so helpful. I'm going to end with just a practical question for folks, which is, for someone who is looking to buy a car right now, here's what I sort of hear you saying, which is, the question I was going to ask is patience going to reward the car
case? But I will say, I think if you can be selective on or open to all kinds of different products in the new vehicle market, I think you will find some significant discounts that have happened in 2023 on very certain products that are just not selling out there, or as manufacturers are trying to gain a foothold in new vehicle segments. So I do think if you're a savvy consumer and you keep your eye out, you can be aware of certain deals in the market. But as a general blanket case, the vehicle market's going to be more of the same in 2023, which is high prices and expensive vehicles. And if you're looking for a discount new vehicle months ago.
All right. Well, Charlie, look, this has been super helpful. Thank you so much for taking the time to, one, come on the program, and B, answer all my, sort of newbie questions about this space, and demystify this all for us. It's been really useful, and I hope we can have you back on the program again in the future, maybe Q2 of next year or whatnot, just to give us an update on where things are headed in the data that you're looking at.
Sure, be happy to do it.
Great. We'll look for it like him as well. Please help us by supporting this program by hitting the like button, then clicking on the red subscribe button below. Well, hit that little bell icon right next to it. Charlie, thank you so much. Really look forward to talking to you again in the new year.
Okay, thank you.
All right. Everybody else, thanks so much for watching.
Of New York. On Tuesday, the SEC charged him with defrauding the venture capitalists and other equity investors who invested in FTX with their rather limited due diligence since 2019. Shortly afterwards, CFTC charges followed, alleging that FTX commingled customer funds and that Bankman-Fried violated the Commodities Exchange Act. There's some pretty wild stuff to read in the three complaints. The fact that Sam Bankman-Fried was the only person charged, at least so far, has led to some speculation, as well as conspiracy to commit money laundering. He faces a maximum 115-year sentence if convicted. The Department of Justice indictment alleges that Sam also broke campaign finance laws by making contributions to candidates and committees that exceeded federal limits. And we'll cover that point near the end of the video. Now, while the SEC can only issue civil charges,